KLA Corporation. Now, KLA Corporation is a semiconductor equipment that designs all the process systems and tools needed to make semis. So this is one of those companies that make the equipment needed to make semis. All right, let's look at the financial performance of KLA. Pretty stable-ish margins. They have been impressive, but they have dipped in 2020. But you have seen a massive, I mean, absolutely massive rebound in 2021. On average, at 28%, KLA has slightly outperformed the industry average, which is at 27%. So that's very decent. The dip can be expected considering COVID lockdown restrictions and disruption to the supply chain. So you do expect a bit of a deterioration, but what's very good is this bounce back, this rebound. That is very, very good. That indicates a very, very well run company. All right. Now, the rebound was in main part caused by a number of factors. Number one, there was a reduction in cost of revenue. You look at cost of revenue growth, it's actually been increasing, but at a downward trend. Massive explosion here, but was cut a bit. Again, that to me signifies a company that realized, well, we're spending way too much than we need to. Let's cut it to protect margins, but at the same time grow. All right. So, considering the current climate of COVID and, supply chain disruptions, you do expect, companies just rein in cost a bit where they don't need to. You don't have to spend what you don't need to. R&D, both as a percentage of revenue and the growth of it, has slowed down a bit. R&D growth has slowed down. It's been increasing, but at a decreasing rate. Again, in 2021, a massive pop. 2020 massive pop. 2021, and has been there was a bit of a massive decline. So it's been increasing, but at a decreasing rate. Okay. However, again, like I said, it is expected considering COVID and the financial impact of that. R&D as a percentage of revenue, however, even though it has been decreasing at an average of 15%, it's still above the industry average, which is 13%. So you're not gonna worry too much. You're not losing track with competitors. I'm not worried about that, considering you might not need to spend that much on R&D again, given the current economic impact caused by COVID. However, all this decrease to me, I'm happy with it because you decrease costs. So you basically decrease what you didn't need to spend on to protect margins and improve profitability. Now, the movement in revenue, so the growth in revenue has been a bit all over the place. Increase and then decrease. It's been a bit all over the place. Um, However, it is still impressive that given COVID, given the effects of COVID, the entity still managed not only to protect margins, so decreasing costs, but increase sales as well. So given the current economic environment, given the effects of COVID, you protected your margins by decreasing costs, but you also increase revenue. So that to me is very, very, very impressive. The net income as well has increased significantly, but that can be explained both by the increase in revenue as well as the protection in margin um, strategy that the entity followed being tight cost control. So tight cost control, increasing sales has led to an explosion in net income. Very impressive. Again, given the effects of COVID, highly impressive though. The fact that KLA managed to grow both the top and bottom line. Very, very impressive. Okay, now cost control, as we discussed, was in relation to, was basically a response to protect margins from the deadly effects of COVID. Now the ROE, the return on equity, is above the industry average. Industry average is about 53%. This has been a so, and the ROE has significantly improved over 2019 to 2021. There's been a significant improvement, and on average, we've outperformed the market. That is very good. That highlights the efficiency of KLA in investing equity in its operations to return above market returns on said investment. So again, very impressive, very good, more than happy. Overall, margins are healthy. Performance has been impressive considering the difficulties caused by COVID for KLA to outperform the industry averages as well as maintain healthy financial performance is very good. It is very good. It highlights a very well-run company and a company that is very strong in its market. Now the financial position. Current ratio outperformed the industry average. The industry average is about 2.9 on average. KLA has a current ratio of about 2.6. So it's a slight underperformance. Nothing to be really worried about. Again, you can be satisfied with the fact that KLA has, $2.5 billion in cash. So even though it's below the industry average, but only slightly, it's still in a good financial position considering that KLA on average has more than almost three times. Looking at the 2018, 2019, it almost has three times the current as the liquid assets to cover to settle current short-term liabilities as and when they fall due. So a company that is in a very strong liquidity position, yes, below industry average, but still in a strong financial position that does not indicate any increase in liquidity risk. Now, the asset test ratio, even though again it also underperformed the industry average of about 2.17, not a bad thing considering KLA has got almost two liquid assets, so that's including inventory because inventory is not that liquid. So excluding inventory, you have almost two times the current assets, the short-term assets, to settle um, current liabilities as and when they fall due. So again, not a, not a, not a, these ratios, especially the asset test, does show me that there really isn't any increase in liquidity risk. This is a very liquid company. So even though both ratios are below the industry average, so the current ratio and asset test ratio, does not indicate high levels of liquidity risk. The inventory days by far above the industry average. The industry average is about just over 160 days, and KLA on average is holding stock for 216 days. A bit worrying considering KLA holds stock for longer than the industry average. And of course, the longer you hold stock, the more carrying cost you're going to spend, on holding the stock, and that will start to eat into margins. However, when you consider the fact that KLA has been increasing margins, been decreasing costs, it's been increasing both my top and bottom line, that's not really eating into my margin. So the fact that it's holding, it's a bit of a risk. There is a risk of obsolete. What is it? Inventory being obsolete. So there is a risk of that. There is a bit of a liquidity risk that I'm holding so much stock, but it's not eating into margins and any risk that does exist. Yes, there's a risk. There's a bit of a heightened risk when compared to the industry, but it's not that much that it will make me, conclude that this inventory, I'm sorry, that this inventory days ratio makes the balance sheet of KLA in a worse off liquidity position. So yes, I, I do have concerns. There is an increased risk, but it's not that bad. Okay, now going to the debt to equity ratio. The industry average is 171%. On average, KLA has 230. Yeah, now this indicates a higher gearing risk. This is a higher financial risk on the balance sheet. This is a very, 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 very risky entity for me. Just by seeing this, considering all the liquidity ratios that underperform the industry, again, doesn't highlight the massive liquidity risk. But considering that they've underperformed, coupled with the debt to equity ratio that's way above industry average, you know, that all adds the financial risk of the balance sheet. So the financial risk of KLA is quite high when compared to peers. Now, what I want you to see is that the relationship between risk being debt to equity and return being return on equity. There's a productive risk. Yes, there's an interest risk, but I also have yes, there's an interest risk above the industry average, but yes, there increased returns above the industry average. So there's a productive relationship between risk and return. Um, so yeah, KLA is very productive in utilizing capital invested to provide or earn returns on said capital invested. But again, quite risky for me. Again, this will be how do you say um, investor depending. Some investors they might like this, but for me, this is just too risky for me. Even though there is a productive relationship, just too risky. All right. So again, looking at KLA's financial position, it does have a healthy-ish balance sheet. However, it does maximize its capital invested, to achieve returns. But it has underperformed quite a few ratios, and all of that considering just makes it a bit of a financial risk. Just makes it too risky from a balance sheet point of view. All right, now the cash position. The cash margin, very pleasing. It's stable. Um Again, the increase supported by the strong margins, tight cost control as well as increasing both the top and the bottom line. The industry average is 26%, so on average, KLA is at 29%, so it's overperforming on that. That is very good. So stable margins that are outperforming the industry average. That is very, very pleasing, very satisfying. The sufficiency of cash flow has been improving, to a point where in 2021 it's above one. The industry average is 0.66. So at an average of 0.71, that is wickedly, wickedly impressive. Um, and again, the increase does make sense. It is supported by the growing margins, the growing cash margins, the fact that, KLA can convert revenue into actual cash that it will then use to fund operations, and KLA does have more than enough, actually above the industry average, to fund all operations. So a very, very, very good and appropriate ratio in my point of view. Now the return to shareholders. Now this is the total return to shareholders. This will include dividends and buyback. So the KLA does engage in dividends and buyback. KLA is very good. It's a very, 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 very good margin. It's a very, very good yield that returns to shareholders. Very pleasing. Yeah, does not let excess cash burn a hole in the balance sheet, but rather uses that excess cash and returns it to shareholders. So a very efficient use of cash in my point of view. Good cash management. So strong margins, enough cash to fund all operations. Yeah, that to me is very good. You're spending enough and you have enough to fund operations. Might as well give shareholders that excess cash. So again, a very good ratio for me. Very, very good. The PE at 26.8 almost 27. It's actually below the industry average. It's actually, sorry, above the industry average of 23.26. So, you know, above the industry average, but by not that much. It is a relatively cheap stock, relatively cheap. Again, even though the share average is 23, over 23, and it's at 26, I'm, I'm not too worried about that. So I consider it relatively cheap, but there's just too much risk. It's just too much of a risky entity, considering you've got debt to equity in excess of 200%, and you're underperforming the industry a bit in the liquidity ratio. So it's a bit of a risky for me, too risky for my blood. But for some shareholders, like this, they might say, "Nah, you're getting way too much," and the risk is tolerable. But for me, the risk is just a bit too much above my risk appetite. Decrease in over the past year, but again expected since the stock market has been going through a bit of a reprice.